Hello. Now, in the mutual funds section, we will look at equity funds in more detail. You can find the link to the summary section on mutual funds in the description. As the vast majority of the money invested here is in equities, let's briefly look at what equities are. A share is a security with no maturity date. If you are a share owner, you own the company that issued the share in proportion to the shares you own. The most common type of shares you will come across on stock exchanges are ordinary shares, the base type of shares. Because you have become an owner of the company by buying the share, you are also entitled to share in the profits made by the company, for example to receive dividends. This is only true for individual shares. Do not expect the same from a share fund, where you do not own the share. The fund manager does not pay you dividends on shares, but can instead include this income in the share price. As a share is a marketable security, this also means that it can change hands at any time. Where does the equity fund invest? This fund invests overwhelmingly in equities and to a lesser extent in lower risk securities. Although the exposure to equities can be as high as 100%, the fund manager also tends to keep a relatively small proportion in liquid assets to ensure smooth redemptions. The specific stocks that will be included in the fund's portfolio will be specified in the fund's description. Accordingly, you can specialize by geographic region, but you can also select economic sectors without any geographical constraints. Exchange-traded shares may be included in actively managed and passively managed equity funds. Equity ETFs are one of the most common and perhaps easiest to create. This has already been discussed in more detail in the section on ETFs. The link to the video is in the description. In active trading, the fund manager not only chooses stocks, but can even decide whether or not to take out a loan. Equities and equity funds also offer a good opportunity for absolute return funds to achieve nice results. What's more, partly because of the high volume and high return prospects, you can also access equity funds as a fund of funds. You then buy a mutual fund that invests in other equity funds. This has its own advantages and disadvantages, so if you would like help in making your choice, please contact us using the link in the description. What is an equity fund for? In short, it can be used to build capital. Because their average growth rate exceeds inflation, they give you the purchasing power of your money and you get more. These funds have a high level of risk due to their high equity exposure, and their return outlook is correspondingly high. Otherwise, you wouldn't put your money here. The risk here means that price movements can occur within a relatively wide range. This risk can be mitigated by stretching the time horizon, so the recommended time horizon for these funds is usually between 5 and 7 years. From this, you may already guess that this is an investment for long-term capital accumulation. If you think in terms of a time horizon of less than 5 years, you can still get nice results, but this is the exception rather than the rule. Don't assume that if your neighbor has been able to generate 20% returns in the last 2 years, even per year, that you will be able to do the same in the next 2 years. Equity funds are not the way to go for your short-term financial goals. If you are thinking short-term, you can still hold money in equity funds, but only do so in very small amounts. That way, even if the share price is going down, there is nothing to jeopardize your goals. You might ask whether you are happy with the big movements in the share price. Obviously, you could have a perfectly straight share price, which is the same as, say, a bank deposit, and you would get the same return as you would with a share. What this would mean for you is that you would want that kind of return for risk-free investments. In the current market environment, risk-free investments don't have that much. The extra returns you get are due to the extra risk of equities and equity funds. Now let's look at what can affect the performance of an equity fund. It can depend on a lot of things. The first of these is the performance of the underlying stocks. For example, the price of a share is affected by the risk associated with the company's operations. What industry it operates in, how efficiently it does its job, who makes up the company's management, what its dividend policy is. If you think about it, you prefer to put your money where you don't take more risk than necessary and your money isn't being siphoned off. Investors are the same way, so they prefer companies that are predictable, stable, have transparent management, and have a competent and experienced management. The second influencing factor in the list is geographical exposure. Depending on the country in which equity fund managers invest in their portfolios, there may be country-specific risks. These may include, for example, the exchange rate and interest rate policies pursued by the central bank of the country concerned. Through interest rate policy, it can make it more difficult or easier to borrow money, thus indirectly affecting the company's performance. The same applies to the management of labor. The way a Chinese company manages human resources is very different from, say, a French company. In addition, especially in more politically charged countries, it is also important to know whether elections are due in the near future. Investors like stability, so when there is a possibility of a change in the governance of a country, and thus the operating environment for businesses, they are reluctant to invest in equities, and may temporarily rebalance their existing investments into less risky solutions. Among many other factors, the performance of the fund is affected by production conditions. This can also happen when a natural disaster strikes an area. As production then stops and sometimes even restarting can be questionable, the market reacts very quickly. Fortunately, a natural disaster only affects a narrow geographic area, and is more severe when it hits a supply chain. Globally, however, think of the quarantine situation caused by the coronavirus. Many companies temporarily halted production either because so many of their workers became ill that they could no longer cope, or as a precaution, or because their products were not available for purchase by customers at the time. Demand for the products of many companies fell because customers were not sure of keeping their jobs, or delayed buying because they could not use the product while quarantined at home. The performance of these companies, and therefore their share price, has fallen. This is, of course, a temporary situation, as the fact that investors do not see much profit potential in this, means that the factories are still there, and will be restarted when conditions are right. Now that you are familiar with this mutual fund, let's look at what to look out for when choosing an equity fund. The first thing you should definitely look at is your own risk tolerance. As equity fund prices are among the most volatile, it doesn't hurt if you can tolerate this. If you take every drop in the share price to heart and panic, then however much you might need the returns available, this investment is not for you. You stand to lose far more by hitting the sell button after the plunge to escape the panic. If this is not a problem for you, because you know that the sun will shine even brighter after the biggest downpour, then you can start thinking about this area. Another thing you should definitely look at is the time frame available to you. Know when you expect to need the money. We've already discussed earlier that it's definitely a good idea to take the recommended time horizon seriously because of the high volatility of the exchange rate compared to other asset funds. While it is possible that you could achieve a good result within a year, the market will not follow you. If you don't take this into account, you could find yourself in a situation where money is desperately needed but you can't yet make a profit. So either you exit at a loss or you may otherwise be subjected to unnecessary stress. After that, what you look at is the performance so far. As with any investment, it is definitely wrong to look only at how the fund has performed so far. That ship has sailed, so don't expect the same returns to be yours in the future. Nobody can guarantee that. What you should be looking at is how it has performed in the past compared to the benchmark, other investment funds investing in similar areas. After all, the way money is managed is likely to continue in the future. Whether it is in the area of your own risk tolerance, financial planning, or asset fund selection, we can advise you. Link to this in the description. Whether you choose your own equity fund or seek expert advice, you should know that there is no investment that is risk-free. The only difference is the degree of risk. So let's now look at the risk of an equity fund. I could list many risks, but for now let's just look at the more important ones and the most common ones. Perhaps first in the queue is the risk of currency exposure. If you are not specifically investing in foreigns and are considering a fund that invests only in Hungarian equities, the purchasing power of the forint against the foreign currency also matters. This is nothing more than the fact that if the forint weakens significantly, the exchange rate is expected to rise just because of this one factor. This situation is less suitable for buying, but can be good for selling. This risk also includes the fact that the exchange rate at which your order will be executed is not known at all. So if you place an order, don't be surprised if you get a slightly different rate than what the exchange rate showed. The second is geographical and industry risk. This risk was mentioned at the beginning of the video, right? It was then listed under factors affecting performance. And yes, risk does affect performance. Liquidity risk. In a panic situation, investors first sell assets with higher risk and flee to risk-free investments. This is particularly true for equity funds. In such a situation, a large redemption of shares results in the fund manager being forced to sell the underlying investments at a discount, if necessary. The next risk is the risk of exchange rate movements. The stock market price looks something like if someone wanted to draw during an earthquake. In a good case, there will not be a straight line for long, as that would mean the market is sideways. In other words, it means that investors don't trust it. You saw this after the mortgage crisis of 2008, and you can see it in the picture. Once confidence was restored, the price of equities, and with them equity funds, showed a dynamic change. What is true on the upside will be true on the downside. You can also see in the picture the downturn caused by the crown virus, which was far more pronounced than for a bond fund, for example. This risk for you means that if you have an exit point as a target date, you have no control over whether you will not see a decline at that time. A fall in the exchange rate would then mean a lower amount in your hand. This can be avoided by moving your money into shorter dated instruments closer to your target. Then you won't get as high a return on them, but at least you're guaranteed to reach your target.